All right, thanks, Brian. I hope everyone had a great lunch session. So for this panel, we're going to talk about the impact on AI on startup and VC. So we're not going to touch a lot on the technological advancement and details on AI. I think that is going to be saved for the next panel. But as I said, the AI is changing the way startups are made and scaled, and also I think it's impacting how the investors are investing in those startups. So we're gonna talk a lot on that. I want to have divide this maybe panel into three major sections. One is that I want to ask the panelists each for the perspective they have on the current state of AI. What excites them, what worries them, and stuff. And secondly, how the AI is changing the way they manage their company or their investment fund. And lastly, the future prospect. What's going to happen in the next 3 to 5 years or so. So let's kickstart with. So we have this in G1, the long-held tradition of not doing a formal introduction. But to lay the groundwork for this panel a little bit, I want to ask each of you to give maybe 2-3 minutes, what you do, how you relate to this topic, and what's your general view of the current state of AI? What excites you and maybe what worries you? And let's kickstart with Andrew.
Sure thing. Can everyone hear me okay? Awesome. So I guess it's not a formal introduction, but I'll try to still give people a sense of what I do all day, which is I'm an investor. I'm a capital allocator. So venture capitalist basically means I specialize in investing in earlier stage companies with a higher growth ambition or prospect. We take more risk than the typical investor. And for that, we're hoping for bigger wins in the cases of success. Because we're taking more risk, there's going to be cases where it's not successful. And so in net, we have to perform. And that means we have to swing really, really big. So that when it works in a big way. I've been doing that for the past dozen or so years at a very large firm that's been around for a very long time. And one of the cool things about that structure is it means we can write very small checks. We can also write very large checks. And so we invest at all stages, all the way from the earliest stage, a couple people with an idea, maybe not even a PowerPoint slide yet, through to pre-IPO companies that are about to go public, and everything in between. And before that, I was doing, private equity stuff. Before that, I was a founder, which I think is very relevant for the role of VC. It creates this empathy that I think would be very hard to replicate, not having been in the founder's shoes before. And, before that, studied engineering and econ. And so I've always loved this nexus of technology and engineering, entrepreneurship, founding things, and also the economics and, investing side. So that's me in a non-formal way. How I relate to this topic, I think should be pretty obvious. We're investing in AI companies. This is like undoubtedly the next great technological wave, probably several orders of magnitude more impactful even than the internet. And so I think, what's interesting is there's a cognitive dissonance right now, which is that two things can be true at the same time. We can both be in a bubble where there are crazy valuations and crazy deals happening. And at the same time, the macro trend can be absolutely right. It can be absolutely spot on. This is going to change everything. And I very firmly believe that's where we are today.
Thanks. Excellent. And I'm just curious now, how much of your recent investment went into AI startups, so-called AI startups?
Basically, everything has an AI angle now. It would be like asking a VC in the year 2000, what percentage of your portfolio companies are going to have something to do with the internet? And the answer is like, well, every company has something to do with the internet now, right? So it depends on how direct, like some of our companies are AI infrastructure companies that are directly underlying AI. Some of our companies are just going to be beneficiaries or users or involved in AI more at the application layer.
Excellent. Thanks. And Kojin?
Hi, everyone. I'm Kojin. I guess Andrew started from most recent to previous background, so I'll start the other way around. So I was born and raised in Tokyo, came to the States for college. I went to Harvard and studied computer science. Specifically, I was conducting research on security for AI. And what it is we were essentially hacking AI models in ethical ways, trying to find vulnerabilities, and we were building ways to protect against these vulnerabilities. This was in 2016, 2017-ish time. There were in the order of maybe like 20, 30 researchers in the world who cared about this topic. And so essentially we saw a huge gap between what AI was about to become and the risks that were involved. So in 2019, we started a company called Robust Intelligence, which was a startup focused on testing AI models and automatically protecting them. And we raised funding from Sequoia and Tiger and many others, raised a total of 60 million, had customers like IBM, JPMC, Expedia, Department of Defense. Last October, we sold the company to Cisco, and now we're leading an AI organization within Cisco. So that's a little bit about me. I guess the state of AI. I think the view that I have is for a lot of the problems that people are trying to solve today, the AI tech is pretty much there. And the blocker to adoption is not the tech itself, but actually the understanding, the literacy, the organizational structure of the ones that are adopting the technology. So my excitement is the fact that the tech is so advanced and it's also advancing like even right now. My fear is people may not have the capacity to adopt it as quickly as possible. And that might slow down the level of progress and advancements we can make.
Okay, great. Thanks a lot. Rebecca?
Hi, yeah, sorry I'm not with you all today. So I am an investor, like Andrew, so same, day job. Mine varies a little bit in that I started Canvas back in 2013, and we invest in the Series A and B stage of companies. We have a pretty concentrated portfolio on that stage. And what that means is the company that we invest in has a product that consumers can see, touch, and feel and use. And a lot of that, I was an engineer also in my prior life. I launched products internationally, including some of the Japanese market. So I would do new product launches with Procter & Gamble. And that has informed a lot of what I do today. So we invest in A and B because that's when you have consumers you can talk to. And what we help with is really the go-to-market and the scale. And that's where we excel. We focus in fintech, digital health, and AI. And I've really had a front row seat, I feel like, to AI since the beginning of my venture career. We were the first institutional investors in Siri. And when Dag and the co-founders pitched Siri to us and talked about the prospect of what Siri could do, it was essentially agentic AI. It would do everything for you. But the tech really wasn't there yet. And we sold that company to Apple. I was then in Figure 8, and that was AI and machine learning. We did the data tagging and built the machine learning models, but still early. And then most recently case text. And that's when we just saw AI take off. So case text was one of the first 3 or 4 companies in the sandbox for GPT-4. We saw what 3.5 could do, and it wasn't enough. And just the leap forward with GPT-4 allowed case text to actually pass the state bar exam for lawyers with the accuracy of 80 to 90%, which is incredibly high. And so I've seen that whole evolution of what it could deliver. And I think with AI, it's been just phenomenal what the progress we've seen and just this huge leap forward. And then what worries me is that a lot of things work in demo land that do not work in production. And we see this time and time again. And so it's something that we're pretty aware of, in our venture firm, and we're investing in companies. But there's a big difference between a constrained environment and the wild. And so we're always cautious about that when we're looking at new investments.
Okay, great. Thanks, Rebecca. And I think Andrew mentioned that, everything is AI now, all startups are. And my next question is, are there any sub-segments within AI? Could be some tech stack or some vertical that you are especially, hopeful for example, in the next year or so in 2025? I think maybe Andrew, we can start with you.
Yeah, sure. So from an investment perspective, I've been spending a lot of time in the picks and shovels layer, AKA the tools that are underlying this AI gold rush. The reason I'm excited about that layer specifically is because just like in this gold rush analogy, you don't have to bet on the specific prospector or the specific prospect site. You can benefit from the rising tide of the entire category. So just to give an example of something like that, one of the things that undoubtedly will shift in an AI first world is business models, right? So SaaS has kind of historically been the business model of, technology software. You're selling essentially all you can eat seats-based subscriptions, whether it's per user per month or enterprise tier or what have you, it's all you can eat, right? And the reason that business model worked is because there was essentially zero cost or very low cost to serve your users or your customers. That paradigm like radically shifts in a world of AI, where the more the customer uses your product, the more actual COGS you incur. So it's kind of like a back to basics, back to old school, where because there's actual cost, there's COGS associated with serving that user, you need to monitor how much of the product they're using and charge them based on that. So it kind of looks like a utility in many ways. And so this is just an example of the type of picks and shovels investment, that we're making. But we've invested in a company that provides the billing and telemetry layer for AI. And so they're the billing and invoicing and software and ERP that's powering OpenAI, Anthropic, Databricks, NVIDIA, Confluent, et cetera, et cetera, et cetera. There's one company that's powering the billing infrastructure for all of these foundational AI companies. And that's like the type of investment that I get really excited about, because I very much believe that one or several of these foundational AI companies will be huge, right? Will become this like massive utility player in the future. And maybe all of them will, but there are these really cool asymmetric investments that you can make where you get that upside and you don't even have to take on that level of risk. So that's like the investor perspective, for sure. But that's one of the trends I'm really excited about.
When there's a gold rush, you want to invest in picks and shovel. How about you, Rebecca?
Yeah, I love the picks and shovels also. I think that's a great analogy. And we had the sort of the transactional model that, we put into place when I was in Figure 8, and it's very different. And the challenges with these transactional models are they're not very sticky. And so you have to make sure you have, real switching cost, to come in and out of them. And that's the challenge with a lot of, what we've seen in these very rapid growth of revenue in AI companies. But it's not, not super sticky oftentimes. So where I spend a lot of time investing is in financial services and in digital health. And we're thesis-driven investors. So we've done, companies including like Lending Club and Doximity and others. And we've had theses along the way that we've maintained that just weren't possible yet. So revenue cycle management in healthcare, healthcare is 22% of the US, GDP. And 40% of that number is really an administrative cost. It's setting prices, disputing prices. And for years, we've looked at opportunities in that sector, that could really help solve that issue. But, it was all run by spreadsheets and people, and there really wasn't technology to truly help answer it with a gross margin efficient business. And there is now. And so that's one example of an area really at the intersection of fintech and digital health that we find really exciting. And I think the huge unlock in terms of what we see for AI is voice. And maybe that comes from, Siri and my experience there, but creating a whole new user interface and user paradigm with voice is I think, a much bigger opportunity than with anything written. And the reason is, and this number came out pretty recently, is that the percentage of people living in the US functionally illiterate is 21%. And so voice is a huge unlock, for a big piece of our population to reach, largely with healthcare, with financial services, opportunities and the like. And voice is a huge leveler for people. And so I personally think the biggest unlock is really around the voice application of AI.
I love that answer, Rebecca. I'm going to have to introduce you to my portfolio company, Whisperflow.
Oh, absolutely. Would love to.
Which has become, I have a similar kind of like thesis, which is that all knowledge work is essentially going to look like vibe coding, and the interface is going to be voice.
Yeah. Yeah, my kids are dumbfounded when they can't talk to something and make it work. When they can't yell at the lights and turn them off, they're astounded, you know?
Kojin, so I want to ask you impact of AI in operating startup and building product and managing your business. So you started Robust Intelligence 6 years ago, and you've seen the wave of AI in those 6 years. How did this advent of AI change the way you make your product and build, manage your team, go to market? How has that changed?
I think it most significantly changed our development process and a lot of the areas that require expertise. So I'll give you an example that is somewhat specific to our startup. So what we're doing is, so we're securing AI. So we need to know the latest information about the various vulnerabilities of AI. And we need to collect that from different sources. We need to collect it from the public web, dark web, recent papers that were written. And what we used to do is we had essentially an army of people going through archive, going through the latest news, creating feeds, ranking them, reading them, writing manual reports, deciding what to do about it, and then actually coding up solutions for these vulnerabilities. And we're now doing that with a little human touch, but mostly agent-driven way. So we have agent essentially sourcing through different channels, prioritizing which ones to create reports on based on some inputs that we give in. We have a template that we've told AI to create a report based on. We do a basic human review just to make sure that it's good. And then we ask AI to convert this report into a piece of code, which again, we do a code review, but then ultimately embed inside our application. So basically, we were able to segment different parts of these processes and replace each process at a time with agents, and then add human auditing or human in the loop in between just to make sure the whole process goes smoothly, and then we can also make improvements along the way.
Okay, that's great. So you mentioned about improving your product and the process and everything. How about on the efficiency side? There's talk about doing more with less. How has that impacted the way you manage your business?
I think definitely with hiring, it became easier to not have to hire. So when you're at a startup, obviously things are scaling and people will come to you for more resources. And now I feel like before there was this trend where kind of hiring and scaling is a cool thing. Now I feel like the cool thing is to not scale, but generate revenue. Like it's like, oh, you're like generating hundreds of millions with like 50 people. That's awesome, right? That's kind of the landscape here, and that has shifted the mindset that we can share with the team, and set the tone that like, no, we're not gonna give you headcount for free, or we're not gonna just give it to you. Let's be creative about ways to make improvements without just immediately relying on headcount because it's expensive and we have to train them. And so I think it made a huge mind shift amongst the management, definitely, and also for the whole team in terms of recruiting.
If you have to put a number, like how much efficiency gain do you feel like you got in the last, I don't know, 2-3 years? And do you think that will continue going forward?
Number. I think it varies by domain, but for example, the process that I described in terms of security analysis, I would say we had like 70% gain in terms of we could have easily hired Like right now, the process is run by like a person or two. We could have had like 5 people working on it and way more. And so that's in certain areas, that's definitely the level of gain that we've had.
And do you think that'll continue the improvement?
I think in that area, I think we peaked. I think in certain areas we will probably improve, but a bit more by a small margin. There are many other areas where we haven't made those improvements, and in those areas, I can see a drastic improvement.
Okay. And Rebecca and Andrew, I'm sure you're seeing a lot of startups in your portfolio, in the companies that due diligencing on. What changes in the startup playbook have you seen in the last 2-3 years? Rebecca, do you want to start?
I can, and I'm very interested in what Andrew has to say too. The main changes are how fast you can realize revenue. I think, especially on the consumer too and enterprise, it's very easy to get products kind of up and out the door. And look at how fast Lovable, for example, scaled their revenue. And so that has really shifted. And so people, and you're seeing in rounds done for incredible valuation multiples on revenue. And my concern with that still is it's not easy come, easy go, right? How hard was that revenue to really create? And is it sticky, or are 3 more companies going to pop up, and how fast can they grow? And so I do think how we look at companies and how we view revenue, time to revenue is really shifting. I'm in a company called Savvy Wealth, and they are the fastest growing registered investment advisor ever. They crossed $1 billion of AUM in about 2 years, and they went from $1 billion in October to $1.5 billion in April. And it's all about efficiencies that they were able to capture with AI. They basically gave an investment advisor 90% of their time back by doing all the rote kind of manual work. And so when you look at that growth, you really want to make sure you're investing in a business that has high switching cost and can maintain, customers over the long haul. And that focus is more now than it's ever been before when we're putting money to work.
Andrew, your take?
Yeah, +1 to everything Rebecca said, for sure. So absolutely, we're seeing teams, and Kojin, you're completely right. The cool thing now is to do more with less. So teams like really pride themselves on having small head count and growing revenue. In terms of competitive advantages, I think the one that is mattering more than anything else these days is agility, because staying 10 or 20% ahead of the competition is where you get an advantage now. And the rate at which your competitors in the ecosystem moves has become very rapid. And so like one of the meta things that we're diligencing when we meet with teams is like, how quickly can they shift, execute, ship, pivot, et cetera? Because that's one of the only enduring advantages these companies will have. I mean, the big thing that so many people are pursuing in AI from all these different perspectives is like some version of this AI like personal agent, right? There's so many companies that are going after some version of this, whether they're trying to do it with a voice interface, and that's how they learn everything about you and start to automate parts of your life, whether they're doing it as part of a big incumbent like Microsoft trying to become your co-pilot, or Google trying to do that via Docs with Gemini, or companies like Limitless or Rewind that are trying to record everything. They start out as like note takers, et cetera, and then they get all the context on you and they eventually become your personal agent. It's like the blind man and the elephant. They're all kind of poking at this same big vision, which is that we're going to become increasingly augmented and automated. We're going to become more cyborg than we already are. But they're all coming at it from different angles. And the only real moat that any of these companies has is their agility and their ability to kind of like stay ahead of everyone else. Because when you think about it, for any of the companies I just outlined, there's not truly a moat. You would have thought that Google had a moat in search, for example, but look at what Perplexity's been able to accomplish, right? You could say the same thing about Microsoft building Copilot, but look what Glean has been able to accomplish. There's all these examples of companies that you'd think would have a moat, but because of how quickly the power of AI is expanding and changing, the only true moat these days is agility and being able to stay consistently 20% ahead of everybody else. So that's one of the big changes in terms of the playbook and in terms of what we look for now.
What do you think about that, Koji? How to build moat, has that changed in this era of AI where everything is changing so fast?
Yeah, I feel like I don't think it's hard to make tech the moat anymore, and I feel like distribution will likely be the moat. And I mean, I've observed a lot of in the previous panel, I asked a question about AI roll-ups because I've seen a lot of startups raising a ton of capital, buying legacy companies that are not tech-enabled, but have a lot of distribution, enabling them with AI and making them efficient. And the reason why they're buying these companies is because they have the tech, but they don't have the distribution. And they know that as soon as they find product market fit, they're going to be gazillion other players that can vibe code and catch up in a matter of like a month. And so the only moat they have is the distribution. So I think the other aspect is you want to move fast. As Rebecca said, you want to be in a sticky market. The other thing is owning the distribution, I think, is even more critical, and you want to do that earlier on.
And thanks. And I also want to touch on that. You said that the new cool is that doing more with less. I would believe that that would probably mean that startups are hiring less, so they are burning less. And as Rebecca mentioned, some AI startups are making revenue quite early on. So I would assume that those startups probably raise smaller capital than maybe before. My question is, how does this new era of AI startups impact the world of investment thing, VC investment? Do we need like a huge capital, huge fund, as in 2020, 2021, or has the model changing?
I would say in terms of capital intensity, it's kind of a tale of two cities with AI specifically. So even though the spend on labor doesn't need to be as high, the total burn can still be very high, especially in compute. And the other thing that's interesting to your point is it's not actually that round sizes have gotten smaller. The variable that has flexed is dilution has basically stayed the same or gotten smaller, and round sizes have gone up. And so what's happening is you see a lot of AI companies that raise large rounds at large valuations early on. And when you compute what their runway looks like, it's like in the decades or something. And so you're like, how are you going to, you have this war chest and you have 2 decades worth of runway. And how are you going to allocate those resources? Are you going to spend a ton of it, on compute clusters? Or are you going to, squirrel a bunch of this capital away for the long term and not spend all of it in one place so that if and when, the dynamics or the macro picture changes, you're one of the companies that has resources and your competitors don't? There's a lot of strategic choices that come with that, companies never had the luxury of making in sort of the old paradigm. So it's a very interesting moment. Be curious to get Rebecca's.
I think, I mean, I my first company was in the .com, and it feels very similar. And, a ton of money doesn't make a good company. And no matter what, you're still paying for distribution. So I've never been, I'm an intellectual property lawyer. I've never been an engineer. I've never been of the opinion that there was any moat for tech at all. And that the only real moats were execution and distribution channels, and that's it. And so that's the same today. And the companies still have to pay for distribution. And so one of the, I think the companies that are going to benefit the most from AI are companies that have, huge distribution channels already and need to turn on a new feature that they can sell into that channel. And we saw that with Casetext. I mean, Casetext was essentially, cash flow profitable. They had 10,000, paying lawyer clients, and they released co-counsel in March of 2023, and suddenly we're adding 100,000 of new ARR a day without spending anything because they had their current customer base just to turn around and sell it into. and people are willing to do that. So we're seeing a ton of money go into these startups. Some of it is on compute, but a lot of it is still having to spend to acquire customers and get sort of the word out there and then manage those customers. And so that hasn't changed. And we always look for startups that are frugal, that, you know, really pay attention to dilution and that raise, you know, what they need to get to the next stage, because we've seen this game before. You know, I lived through pets.com and all of the early stuff, and huge companies came out of that time period, including Google and Amazon and others. But there were a ton of very overfunded companies, the likes of Webvan and others, that had a ton of capital but didn't make it. And so I think, you know, it really feels like that day and age again in a lot of ways. And so, you know, we look at, you know, companies creating real defensible businesses that, you know, that are solving a big problem for people. And we continue to do that, and don't believe that this overfunding is going to have any direct correlation to, you know, enduring businesses.
You mentioned, you know, you've seen this, you know, played before. And, you know, based on your lessons from the maybe previous cycles, how do you differentiate from the ones that's likely going to survive and become the next generation legendary companies, and the ones that will end up as a hype?
Yes, I mean, the way I think about it is are they solving a real consumer pain point? And, you know, are they doing it profitably? It is amazing. This happened back in the last .com too. How much money can be burned? I mean, tens of millions, hundreds of millions of dollars a year on businesses that kind of don't have the right to exist, right? And so, you know, there are many that do. And so we focus on ones that could, you know, that have a strategy for profitability and could become profitable. And with the advances in AI, there are many more of those that the gross margins are just a lot more attractive. And so we look again for companies solving real problems with real business models that are advantaged by the progress in AI, and not companies that are spending more than they could ever possibly make.
Any points on these points? Any comments, Andrew and Kojin?
I thought that was super well said.
Thank you.
I echo on the point about, I mean, I didn't live through .com, but like what I'm observing somewhat from the inside is, especially for like around tooling and infra, there's a ton of money on the foundation model providers and some of the big kind of AI firms that are essentially creating a ecosystem, or I may call it even an echo chamber of kind of money flowing within, and that is creating this cycle where these big ones are spending money on startups, they're growing revenue so they can raise at a higher valuation, and some of the big techs are chipping in on that, and that is going in and then cycle, and then I wonder how long that is gonna continue.
Yeah, that's the big question. And maybe moving on to the future, you know, with this, you know, changes happening this rapidly at this rate of change, it's almost impossible to predict about the future. But if I press you to make some bold prediction in the next, let's say, I don't know, 3 years or 5 years, what do you think will be the, you know, the state of startup land with this, you know, advent of AI? If you have to make a, you know, bold prediction.
So this, I kind of said this earlier, but I think all knowledge work is going to look like vibe coding, and voice is going to be the interface. So if you want to make a PowerPoint, you're just going to describe what goes into it. You'll probably do that with voice, and the AI will make it for you. If you want to analyze something, you want to build a spreadsheet, you're going to describe what the spreadsheet needs to do with voice, and you know the AI will do it for you. And you can just apply that model the same way people are vibe coding applications to basically everything that knowledge workers do. And so naively, you might look at that and say, you know, okay, you know, how much of our jobs are going to be automated away? But I think what really happens is that we're just going to end up all trying to do a lot more, because there's a big difference between something where the demand for output is totally elastic, like knowledge work. We can output a lot more knowledge work. We can always do better analysis. We can always produce more, thoughtful insights. We can always dig deeper, right, and have better decision making than things where the output is inelastic. So people often look back at like agriculture, as a great example for automation. And the panic at the time was you have the tractor coming in, one person goes from being able to farm 2 acres to being able to farm 200 acres. 80% of the population is involved in agriculture. How does that change the job landscape? I think what's different this time is that unlike agriculture, where there's only so much output that's really needed, you can always do more. And that's I think what we have is this world where, like, because we can do more, it's actually going to feel like more overwhelming. We have more work we can do and more work we should do. You have like a brief idea where in the past you're like, no, I don't have time to pursue that at all because it would take 100 hours of coding to build up this little application that I had an idea for. Well, now that it takes you 1 hour to build that application, you might as well do it. So the amount of things that actually come onto your plate and become doable increases significantly. And so I think we're actually going to end up being inundated in more work, not less, as a result of all the productivity tools we have.
Kojin?
I think the boundary between solely product-oriented startups and services company will start to be more blur. And what I mean by that is, I mean, it's kind of related to everything we've been discussing, but if tech is easily replicable and if distribution is what matters, and if I'm a startup that is building a product, I have to either gain these distributions myself and make it sticky, or buy a company that's doing that already. And that will inevitably create a situation where I have to do a bit more than I'm offering through my product only. That's reason number one. Number two is the characteristics of AI agents is very different from the characteristics of traditional SaaS applications. SaaS applications is you're optimizing for a very specific function where you're essentially breaking up different processes into small pieces. And for every small piece, there is a SaaS solution that you can use to solve that problem. Whereas agents are optimizing for the end goal, and you're creating a workflow by combining multiple agents in one workflow to solve that single problem. And if you want to solve that whole problem, you can't really hand over just a single product and a documentation and let the users use them. You need to work with them to create that workflow. And so I'm sure there will be a lot of places for consulting firms and these firms to still play a role, but I also feel like a lot of the startups in classic sense will try to enter into this space as well.
That's interesting. And maybe the value accrues to the few winners. Maybe the power law is going to be even more dramatic. Rebecca?
Yeah, so you wanted something out there, right? So I agree with Andrew on voice, but I'll take it to the next level. I love Neuralink, and I actually think you're going to be able to think and get an incredible amount of things done that are wired in. So that's my out there prediction, and that everything will have AI. But I actually think this Neuralink thing is super interesting.
Okay, so thanks. Before opening up for the questions, I want to ask one last question, which is that a lot of the things is going to change in the next 3-5 years. What do you think will stay unchanged or remain the constant in the startup playbook, or the way you create a startup, or the way you make investment? What's going to stay true for the next?
Yeah, can I go first on this one? Yeah, can I actually think what will stay true is Silicon Valley being the center. I've been doing this for almost 20 years. There have been many ebbs and flows, and even with COVID, people thinking that it was going to move elsewhere. But there are a lot of good reasons why it remains in Silicon Valley and the Bay Area. And so while there'll be companies in other places, I think Silicon Valley will still be the epicenter.
I think brand and people will still matter the most. So you need to have great people that can tell a great story and attract the capital, talent, and customers, right? The key resources that they need to build their company. And that's not going to change. Even if they have AI doing a significant amount of the work, it's still going to be about great people who can build and craft a great story and therefore a great brand. May
become even more important. Yeah. Okay, I want to open up the floor for the questions. Maybe I'll take 2 or 3 questions in batches. And the first one, Simeon.
Okay, awesome. I want to slightly disagree with the panel in my question on this is like the internet era. We have hyper concentration. 70% of compute is owned by 3 companies. Those same 3 companies are the largest companies building models, owning the startups that are building those same models. They also control most of the data. I'm a co-founder of a AI startup, and I'm a pessimist on my ability to build a Google today, or an or a Microsoft, or an Amazon. Can you prove me wrong?
Okay, thanks. That's a great question. And you had one?
Thank you. Okay. My name is Kota. I run AI startup in Tokyo. I have a question because yeah, AI will raise an ethical problem. There will be more chance with rule making industry or policy making industry and so on. So how should AI startup make the business into these categories? Yeah.
So your question is, how should AI startups influence policies? Influence policies. Okay, great. And maybe one last question here.
Thanks for our very insightful panel. So my questions are on GTM for the enterprise. Most of our high growth AI startup is very product-led growth. And but there are like a ServiceNow or the Salesforce or for the enterprise GTM. What do you think? Is there PCL works or still the old style of enterprise sales are really remain?
So the style of enterprise GTM?
Yep.
Okay.
Mid-size and the enterprise side. Is there any change maybe happened?
Okay, there's a playbook change there. Anyone can take any questions. I don't think.
Can I take the first one, please? Because that was, you said Primyong. So
Sure.
If I can take that first one, and I think the question was, it's the concentration question and how to build a Google today. And I remember when Google started, right? And everyone said, wow, we need another search engine, like we need a hole in the head, right? We had Atomi, we had Alta Vista, we had Yahoo, and it was a whole different ballgame, right? And so we had Google. The same thing with Facebook. Why do we need yet another social network? There were plenty before Facebook. So I do think I don't disagree that the majority of the benefit of AI will accrue to very large companies, just like the benefit of the internet. But I do think this new technology wave will create very large new companies as well. So I think both things are very true.
And Rebecca, sorry, just to follow up, I think somewhere you said that you are a big believer in second mover advantage.
Yes.
Can you describe where the advantage accrues for the second mover?
Yeah, I would challenge you to name any first mover. The only one I can ever really think of is maybe Amazon. But I learned this rule at Procter & Gamble. The first mover has to pay so much money and spend so many resources building their product and proving that a market exists. And once they do, it's really easy for a second mover to come in, build a product with no tech debt and get there faster. And so, Lending Club was a second mover. Doximity definitely wasn't the first, company out there creating a medical social network. It's a $14 billion company today. Google was by no means close to being the first search engine. eBay was arguably not the first auction site. Facebook was absolutely not the first, social network out there. The list goes on. And in fact, I would even challenge you to name products that Google has that they actually developed themselves, right? Most of them are acquisitions that they then scale. So I'm a huge believer in second mover proving out, really second movers actually taking advantage of the market created by the first one. So
Okay, thanks a lot. And you want to take other questions?
I have a really quick answer. So one, perplexity, existence proof. Two, don't. It's a distraction if you're an early stage startup to go work on policy. And then three, like enterprise still is and probably for a long time will be where a lot of the money is in SaaS.
There's perplexity and also OpenAI too, I mean, they're like 7, 8 years old and I mean, 300 billion. I mean, they're not Google 3 trillion, but getting there, hopefully.
getting there quickly.
Yeah. I can spend an entire day with you on talking about AI ethics and AI security, but if I were to condense it in a short response using my internal GPT, I think despite working in this field, yeah, I do agree that if you're, especially in AI ethics, if you're trying to make a business out of it, it's challenging. Security is a clear cut. It's very clear who the bad actors are, and the solutions are very technical. The problem of AI ethics is less of a technical problem. It's essentially solving this extremely hard problem that people have been discussing in philosophy for centuries on like, what is fairness? What is this? What is that? You now need to put an actual algorithm to encode that. And it's not once we agree on the definition of fairness, implementing is not that hard. It's actually about that discussion. So I think there's a very important discourse to have, but it's not well suited for startups. The best ways to get involved is, there's an association called AI Governance Association that I created in Japan, which now has 90 enterprises in it. It has OpenAI, Google, Microsoft, Amazon, and all the big tech in Japan as well. So, but jokes aside, I think creating a group of companies and like-minded peers is the best way. We created exactly because of that, right? Like as a single startup, I don't have an influence over the government. But if I can have these companies in the same organization, then there may be a way to influence policy making as well. So that's one way to go about it.
And can you also comment on Yasu's questions about enterprise sales? Go-to-market importance, has that changed?
Yeah, I think if I think about it's very related to tech being a commodity, product being a commodity, right? Like ultimately, one approach to making switching costs sticky is through having deep touch points with enterprises, sales, and even beyond sales, right? Like enterprise customer success. And that's why I talked about consulting or some services component is obviously you don't want to do that too much to lower your margins, but you want to do that intentionally to make your customers so sticky. And so there are certainly cases like, code generation is a great example where like PLG just flies. But in a lot of domains, especially in traditional verticals, I feel like enterprise sales motions and enterprise customer success, professional services motion will be ever more important. And you see that with like companies like, I don't know, like Palantir is a great example of having a mixture of those two, both product oriented as well as enterprise federal sales heavy.
Excellent. Let's do another round of questions. Yes, over there. Ransom.
Thank you so much. So my question is about the speed for the globalization. So from the both meaning about go-to-market and the team in the company. So because as you know, so LLM can solve the language issue, right? And then, so now there's no any boundary, but how do you feel as exactly the situation now for each very new startup, the speed of the globalization from the both sides? Thank you.
Okay, startup going global, is it accelerated by the LLMs? Other questions? Yes, Anna?
Hi, maybe a question for Andrew or Rebecca. I'm curious to the extent that you're able to share. I'm curious to hear how your fund strategy itself has changed in the past few years with all this chaos, maybe fund size, investment stage, check size, et cetera, whatever you're able to share. Thank you.
Okay, changes in fund strategy. Maybe one other questions. I thought I saw a hand somewhere. Maybe no. Okay, let's do those two questions. Maybe everyone can comment on everything. Yeah.
What was the first question again, please?
The speed of globalization of the startups, going global with LLM, language barriers are gone. Maybe Andrew, we can start with you.
Yeah, sure. So I think it is true that from a technical standpoint, there are less barriers to going global quickly, but from a pragmatic and practical standpoint, many of the barriers still exist and will continue to exist, meaning, you have to operate in a different regulatory environment. You have to operate in an environment that has different contracting methodologies, payment methodologies, customer, go-to-market methodologies. Like all of these things are still different in different markets and create a cost to accessing a market that is not like your initial core market. And when you have sort of an activation energy cost, one of the things that means is you're more able to bear that cost when you're further along in your journey, because it represents a smaller fraction of like the total stuff you're doing as an organization. And that's one of the reasons why it is often more successful for mid to late stage companies to go international than it is for like a very early stage company to try to go international from day one. It's just math, right? Like if you're a large mass and there's only like a small fraction of that is required to like overcome some speed bump, that's much easier than if you're like a small mass, on a relative basis, that speed bump is a lot bigger. And I think that will continue to be true, even if, on the edges, some of these marginal aspects like the language, localization piece are getting cheaper and easier. You don't have to go translate your application, manually for another market. Like that cost comes down, but all these other fixed costs are still there. So on the margin, that maybe means instead of going, let's say you're a US company and you want to go to Japan or vice versa, instead of doing that at the series D or E, maybe you now can do that at the series C or D, but it's not like you can do it as a seed stage company, any differently than before. That's at least my personal take.
Yeah, I totally agree. I think simultaneous translation is not going to fix tariffs, right? And then there will still be global tensions that will far exceed the gains, the technological productivity gains. An example I can give that we had is we expanded to the Japan market 3 years after we started the company. We wanted to take a strategic investment from one of the large insurance firms there. We had to go through a whole process called CFIUS. It's something for foreign investment, something. And basically, there are certain categories, right? Like nuclear attack, and I think now AI is a key topic there, where foreign investments are generally restricted. And so even things like, let's get a strategic investment so that we can go and partner with these local enterprises, local distributors, that's just going to become harder. So this is just like an example of many strategic things you might do in certain regions that will become increasingly harder due to what's happening right now.
Yeah. And I mean, I've launched products in many countries all over the world, and language is a very small component. Consumer preference is incredibly different in country to country, and also just raw materials too. But consumer preference, even when I was at Procter & Gamble, for color and scent and efficacy and all kinds of things. And so language is an issue at the margin, right? When you're launching companies in different countries, the consumer preference. I mean, even look at Evernote. We had really no real marketing for Evernote in Japan, and it took off. It was one of our early stage companies in mobile that we invested in. And the Japanese market, loved that product, probably, sort of organically. And so I look at it, I mean, even US Coke and Mexican Coke, they're different products and they taste differently. And so, there is a difference in consumers based on geography that extend far beyond language. That has to be understood. And then, of course, you have the legal and the regulatory frameworks that you also have to manage through. So there are both things. And then encourage in terms of like, fund and different and sort of investment pieces. I think that the days of like the mid-market kind of generalist fund are over. I think these days you have to be pretty deep in certain, core areas. And so we focused on where we've made a lot of money for our investors, which is in, financial services and digital health, leveraging AI and no longer kind of doing everything. And we focused on the stage in terms of A and B, because there are unique skill sets required to develop, to really be successful, especially in the Series A and the early Series B rounds that we particularly, like and want to double down on. So we've really focused, and it's ironically something we always tell our companies to do. And it's where I think we'll be the most successful, is focusing.
And do you also want to comment on the strategy?
Yeah, so on fund strategy, for me, what's interesting is that more is actually staying the same than is changing. So we're, of course, using all of these tools, whether it's to parse through large unstructured data sets and like extract answers and due diligence, a bit better. But the fundamentals are still the same. And I think the mistakes that a lot of funds make in moments like this, where you have this high consensus, high conviction, this is the sea change, this is the technology, is that they make radical shifts. So if you look at 2021, or if you look at 99, 2000, funds decided, hey, time diversification doesn't matter anymore. We're going to deploy our entire fund, in 1 year or in 2 years, because this is the wave that we need to catch. And I think for us, one of the big lessons is like, there are some things that we actually don't want to change, such as time diversification and investment pace, et cetera, in an environment where things are changing very rapidly. So I think it's as much about like, what do you want to keep constant and consistent? And for us, being disciplined, keeping the bar high, maintaining time diversification, that's just one example of many things that we are kind of keeping the same. So more is saying, we're using all the tools, but more is staying the same than is changing.
Great. So maybe on that note, we will conclude the panel. But there's no question that this big change is happening, and that is changing the way startups are made and scaled, and also get invested. But I like the fact that there's a lot of opportunity in the room. And let's thank all the panelists for the insights. And yeah, thanks a lot.